All right, guys, episode 5 of the Creative Acquisitions Podcast. In today's episode, what we're going to do is we're going to talk all things subject to. So in previous episodes, we've talked a little bit about the types of creative financing that exist. We talked about seller financing, subject to, wraparound mortgages, hybrid mortgages, and talked a little bit about conventional financing. Now, the reason I want to talk about subject to is you are going to see a large number of these deals in 2025 and 2026 because of two main things. The first thing, before we get into the reasons as to why people have subject to loans, let's talk about what it actually is, right? So if you buy a property and you buy that property with a subject to arrangement, what you're doing is you're basically saying, I will take over your mortgage at whatever your payment is, your principal, your interest, your taxes, and your insurance, whatever that core payment is, definitely the principal and interest. We can talk about taxes and insurance later, but you're taking that over and then maybe making a down payment. Now, the most important thing to consider when doing subject to is how do people get there, right? Like, why would a seller deed the house over but let you make payments to their mortgage that's on their credit? So the first thing to understand is that there are two pieces to every property. There's a deed, which says that somebody owns a property. And then there's a mortgage, which sometimes have a deed of trust or promissory note or some other legal instrument that says this particular person has a payable to a bank. So you own 123 Anywhere Street, that you have the deed for that. That's the piece of paper that says you own that deed. Then you have another piece of paper that says how much you pay, what's your principal and interest payments, what's the amortization, the interest rate, the terms of default, late payments, all that crap, okay? Now, the interesting thing about subject to is generally these are very low equity deals. So remember, if somebody has a lot of equity, if they own their house in cash, that's never going to be a subject to, that's going to be seller financing. So from a mechanics standpoint, yes, it might be similar mechanics, but in a subject to transaction, you, the buyer, get the deed, the seller keeps the mortgage in their name, and you make payments to the mortgage every month. So let's take $1 million house as an example, because we've used this multiple times and I think it makes the most sense. On $1 million house, if the mortgage was $950,000, let's say, and you brought $50,000 down, now you have no equity left in the deal. You've paid that right down, right? So $1 million house, $950,000 mortgage. The difference between $950 and $1 million is $50,000. You bring $50,000, put it down. Now you've taken over the property subject to. Now, in straight up subject to, your term length should be whatever's left on their loan. So let's say they had a 30-year mortgage and they're 3 years in, so they have 27 years left. If the subject to is set up properly, you should only have 27 years out of that 30 years left because you're just taking over payments. They've already made the first 36 payments, 12 payments a year, 3 years. They've made 36 payments. There's supposed to be 360 payments. So you're just going to pick it up on the 37th payment, if that makes sense. So in subject to, again, you get the deed, you get all the benefits, you get the appreciation, the depreciation, the equity, the cash flow, the income, the expenses. You get all the things associated with the property, but you leave the debt over in the seller's name. Now, most subject tos that I've been a part of, most of them, are from people who have VA loans, FHA loans, low down payment conventional loans, or LLC partnerships. We'll talk about all those. So VA loans, remember in previous videos, we talked about how they can be $0 down. Because there can be $0 down, there's a very high likelihood that when somebody wants to move, they have a VA loan on one property, they want to move to another property, there's not going to be enough equity for them to sell the house because they put $0 down. On the FHA loan, you have 3.5% down, which is a similar situation, which is there really is no equity. So when they want to move, they can't. On a 5% conventional, you got the same issue because when they want to move, they can't, right? Because the reason they can't, right, is because in order to sell a property, it usually costs you 8 to 10% of the value of the asset. So let's use our $1 million example again. I know these are big numbers, but just easier to do it on $1 million example. So on a $1 million property, let's say, this would never happen, but let's just say somebody put 5% down, okay? So they have $50K they put down. They bought $1 million house with a $950,000 mortgage. Again, you're never going to be able to do that. That's going to be a jumbo loan or non-QM. It's going to require 20%, but I'm just doing this as an example. So $1 million property, $50K down, there's a $950,000 mortgage. If that person goes and sells their house, remember, they're going to pay close to 10% to sell it. They're going to have 6% to the agents, right? 3 to the buyer, 3 to the seller, maybe a little bit less, maybe 5%, but let's just say 6 for now, plus 1% in closing costs. We're at 7, plus potentially transfer taxes and other legal closing costs. You're talking 8, 9, and maybe some price reduction, call it close to 10. So if we take the $1 million property, it's going to cost $100,000 to sell that property, maybe a little less, 90 or 80,000, but they only have $50,000 in equity. So in order for that particular seller to be able to go out there and basically make a payment like that, right? To be able to, they got to bring cash to the table to close. They're not going to do that, right? A seller's not going to come into the mix. A seller's not going to come into the process and say, okay, look, I have this $1 million house that I put $50K down. I got $950 left in the mortgage. That's still worth $1 million because we've only been 1 or 2 years later. Maybe it's worth, $1,050,000, or there's a little bit of wiggle there, but they can't actually sell it. And the reason they can't sell it is they have $80,000 or $90,000 in expenses, but only $50,000 in equity. So in order for them to sell their house, they would actually have to come out of their pocket, out of their bank account somewhere else with 30 grand and pay to sell their house. They'd actually have to pay more money than they have in equity to sell it. That generates the subject to opportunity, okay? Now, keep in mind, the goals of people in subject to are different than people who have wraparound mortgages, which are different than hybrids, which are different than carries or carrybacks. They're all different strategies, okay? And so you need to understand the specific strategy of each, right? Same with people taking second liens and third liens. They have different strategies, HELOCs, different strategy. So the strategy associated with subject to is find somebody with low equity who bought the house with a low down payment loan, typically under 5%, wants to sell their house, but can't sell their house because there's not enough equity to support the cost of sale, okay? And maybe 10% is too big of a number to use. We talked a little bit about that. It is possible that 10% just, that's not going to work, right? Maybe it's at 9 or 8. But most people who put 5% down and their house goes up 1 or 2% in value, they still don't have enough to sell their house. And generally, they need some cash to be able to go to another property. So think about it this way. That particular deal is never going to be able to have agents on it. So when a agent, as a listing agent, takes a listing that has less than 10% equity in it, the agents should be doing due diligence. But the problem with most agents is they don't actually look at that before they take the listing on. The top 1% will do that, right? The top 1% of agents will be thinking ahead. They will work on it. They will figure it out. They will have a plan, no doubt. But the average agent who's doing homestead retail type buyers, not investment buying, right? Like short-term rentals or long-term rentals or whatever, they're not going to know that. So again, this is an opportunity for you to help that seller out, right? The mentality online from people is like, oh, you're screwing the seller. Why would the seller ever do that? Da, 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 da. Well, you got to think about it from both sides and both lenses. That real estate agent is never going to be able to sell that house because the seller's going to have to come out of pocket $20,000, $30,000, $40,000. But on top of that, even if they could come out of pocket, that's just a bad deal. So instead of that, you could say, hey, Mr. Seller, I will give you more price. I'll give you another $20,000, $30,000 above price. I have no buyer's agent, so you save them another 3%. So you start manipulating those numbers around a little bit to a spot where they get some cash at close to go rent or go buy their next house or whatever it is they want to do. Also, there's something called the lock-in effect, and this is something that's been coined multiple times now over the last probably 2 or 3 years post-COVID. And the lock-in effect is effectively that about 70% of mortgages are 4% or lower in America today. These are residential mortgages. I'm not talking commercial. Commercial goes on like 25 or 30-year schedules with a 5-year renewal, and they have to change every 5 years. They're like adjustable rate mortgages. But in the case of residential mortgages, most of them are 15 and 30 year. Really, most of them are 30-year fixed. And so you have all these people with a 4% interest rate locked in or lower, right? And so those people, they can't really move to the next house. They can't really go anywhere because if they have a $500,000 house at 4%, and they want to upgrade to a $750,000 house, they're going to have to be at 6%. So they're going up 50% in cost, and they're going up 50% in cost in the loan as well, which means that payment's going to be like not double, but almost double. Once you back out taxes and insurance. So the lock-in effect is real. And so the way you can capitalize as a buyer of real estate is you can say, listen, I know there's 70% of homes out there with 4% interest rate or less. Just because somebody's using a house as a homestead doesn't mean it can't be a short-term rental. Doesn't mean it can't be a long-term rental. Doesn't mean it can't get converted into, pad split or some type of group home living, sober living, things like that. That's not the case. You could buy a house. We've done this. We bought a house in Monument, Colorado, subject to. It's a perfect example. We bought it for like 1.4 million. We put down like 25K, plus we paid a wholesaler a fee, and we owned the house. And it was somebody's homestead house, right? Their primary house they lived in. They bought it with a VA loan. No idea why they bought it. It's like 4% interest rate. And I think they're widowed at this point, so they can't really afford the payment. The payment's like $7,000 or something like that, PITI. And they can't afford that. So they said, listen, I got to move, but I don't have enough equity to pay an agent. So they came to a wholesaler, called them, said, hey, do you want to sell your house? They're like, yes, I need to sell my house because I'm behind 2 payments. We caught up the 2 payments. Again, it's like 14 grand, 7 and 7. And then we own the house. The seller's happy because now they're not getting in foreclosure. Now, remember that if somebody misses many mortgage payments, they enter into foreclosure, not like 1 or 2, but the credit gets affected after typically 1 30-day late in a 12-month period of time. And so can you get those removed in credit repair? Of course, but the big thing that sellers are looking for help with is they want to get out of a bad situation. They're either upside down in equity, or they don't have enough cash to pay an agent to sell the property, or a bunch of different issues here, right? There's a lot of situations that set up a subject to, but when you hear subject to in your head, what you should be thinking is low equity. Somebody owns a house, doesn't matter what the value of the house is, they have low equity, okay? Meaning their equity position is less than probably 8%. At 10%, they can sell, be a wash. Almost always. 10% sell, wash. So $1 million house with a $900,000 mortgage, that's not going to be a subject to, probably. It might be, but probably not. Now let's talk briefly about when something is a subject to versus when something is a wraparound mortgage, okay? A wraparound mortgage is when that mortgage is in place, but you're not paying out all of the equity. So on the $1 million house with the $950,000 mortgage, if you pay the full $50,000, so all that equity is depleted out of the property, you're just taking over that mortgage. It's a $950 mortgage to the seller. It's going to be $950 mortgage to you. That's subject to you've matched the 2 mortgages. Now let's suppose that you don't have 50 grand, you only have 25 grand to buy the deal. So you have bought the $1 million house, you put down 25K, so that leaves you 975. Now that becomes a wraparound mortgage because the subordinate mortgage is 950, but your new mortgage is 975. And so in other videos, we'll talk about wraparounds versus hybrids and the differences between the 2 of them. But in general, if you pay out all of the equity, which is the purchase price minus the debt, you pay out all that equity up front, that's going to become a subject to deal. If you don't pay that all out, it is no longer a subject to. The other thing to keep in mind is the term length. A lot of people screw this up. Just because you're taking the mortgage over doesn't mean that you're going to lose the term length, okay? So 30-year mortgage, we talked about this before. If they paid 3 years in, there's 27 years left. You're going to take it over and only have 27 years. You're not going to have 30 years. This is very, very, very important. You got to understand this. Now, the last thing that I will kind of talk about here is what are the risks to the seller and what are the risks to the buyer, okay? This is where servicing comes in place. The risk to the buyer is that you pay the seller and they don't pay the mortgage and they get foreclosed on, which means you lose the house and your equity. The risk to the seller is that the buyer doesn't pay, and so they don't have the money to pay the mortgage. One way to solve that is through loan servicing. We've had a terrible experience with loan servicing as a whole, just absolutely terrible. But the whole concept of loan servicing is you, the buyer, pay the mortgage company, pay the loan servicing company. The loan servicing company pays the mortgage on behalf of you. The reason you do that is so you don't have a situation where you, the buyer, pay the seller pockets that cash, doesn't pay the mortgage, and you get foreclosed on. It also gives a receipt system, a 1098, which is the mortgage interest form, and a payment receipt system so that you, the buyer, and the seller know how many payments have been made within a year, and you can deduct your mortgage interest expense and all these other items, right? And typically when you escrow those, when you put all those payments together with a third-party servicing company, it's typically your principal and interest for the mortgage plus your taxes plus your insurance. Taxes are typically paid once a year. Insurance is typically paid once a year, but they collect it into the escrow account so they can get paid in the future. The other thing to keep in mind with subject to, okay, is that there is something called the due on sale clause. Almost every mortgage has this out there. Due on sale clause says that in the instance where you convey, which means move, basically, you convey a property from whoever had the deed in the mortgage and you deed it to somebody else, the bank has the right to accelerate that mortgage and say it's pay in full, okay? Here's the thing. Banks are not in the business of foreclosing. Banks are in the business of making interest, okay? if the payments are on time, they are not going to foreclose on you. They just won't. They just don't care, okay? The due on sale, I have not seen anybody accelerate a note for on-time payments. If you stop making payments, they're more than happy to pull that card. But in the instance that we're talking about, there's absolutely no reason for that. So if you're servicing, if you're a buyer, you got the deed, the seller has kept the mortgage, you're using the servicing company in the middle, and you're making a payment from the buyer to servicing to the seller and the mortgage company, and it's paid on time every time without pissing them off, and your insurance policy is set up correctly, meaning that your insurance policy lists you as the buyer, the bank as the person who issued the mortgage, and then the seller with some equity. If you have all those parties on the insurance, the bank is going to be stoked. The bank really just cares about themselves. They do not care about the seller. But at the end of the day, you will not have a due on sale clause if you make payments on time. So please, please, please try to set up loan servicing or set up a payment arrangement to make sure stuff's paid on time. The best case scenario for you as the buyer, once you take over a subject to, is to get direct login access to the mortgage portal. That way you can see the escrow payments, which is taxes and insurance. You can see the principal and interest payments. You can see absolutely everything to make sure that nothing's past due, notices, this, that, and the other thing. There's also what's called the limited power of attorney, limited POA doc. That limited power of attorney doc allows you to talk to the bank on behalf of the seller. In some instances, this is needed. In other instances, not. I think in general, people would say this is a good idea to have this. I haven't had to do that very often, but there are some instances where we need to because we're worried about not being able to talk to the bank. A very common issue that comes up with older sellers is they die at some point, unfortunately. And when that happens, you have no power of attorney, which means you can't deal with the bank, which means you might get foreclosed on, which is a massive issue. You might go through probate to wind up the estate. There's a ton of problems that can come up with that. So what I recommend is that if you don't know what you're doing, get the limited power of attorney so you can eventually get the help you need in the future. That power of attorney will stay intact. Sometimes their annual power of attorneys need to be re-signed. Sometimes they're just 30 years. It just depends, but please try to get these signed so you don't have yourself a very difficult situation. We've unfortunately been through some situations where we've had business partners die, we've had sellers die, and it makes it very challenging to deal with the mortgages when you don't have all the paperwork there. So as a quick recap, subject to financing, super good for the buyer and the seller, keeps low interest rate, helps the seller out, gets them out of foreclosure, gets their back payments caught up. A buyer, low entry for you typically, right? Because you're putting a little bit of money down and taking over mostly debt. That's a great position to be in for both buyer and seller. You get the deed, so you get all the benefits of the property: appreciation, depreciation, equity, cash flow, the revenue, the expenses. You get all the things of the property. The mortgage stays over here. No credit, no tax returns, no W-2s, no nothing to qualify for because it stayed in the seller's name. They've already qualified for it. And then you put a servicing company in between from buyer to servicing to seller. That way those payments make sure they get to the bank, including your taxes and insurance payments. In future videos, we'll talk about wraparound mortgages. We'll talk about seller financing more in detail, and we'll talk about the strategies associated with putting these together for short-term rentals. But please, please, please keep in mind that everything I'm telling you, you need to verify this with your state or an attorney in your state or a real estate specialist because these rules are different from state to state to state, okay? Last thing, please do not confuse lease options and subject to. Subject to, you, the buyer, get the deed. Mortgage stays in the seller's name. In a lease option, the deed stays with the seller until the option period. So you're basically leasing or renting the property until you've paid enough payments, then you get the deed. So if you're looking for a ownership benefit, mortgage interest pay down, depreciation, capital improvements, basis, all that stuff within the property, in a lease option, you don't own the asset. It is not on your balance sheet. So you have to consider that in that approach. In subject to, you're getting the deed, so you get all those ownership benefits, put the actual asset on your balance sheet day one along with the debt. So hopefully that's helpful. Thanks so much for watching, and we'll see you in the next video.